I want to start off the podcast by talking about the big sell-off that we had in gold and silver on Friday, which followed a generally up week for gold. Gold was up 3 out of the previous 4 days, pretty much up about $20 an ounce on Monday, Wednesday, and Thursday, and down maybe about $20 an ounce on Tuesday. So we were ahead. I mean, gold was almost up 2% on the week on Thursday. And despite that, gold stocks were barely positive. They were only up about 0.5%. And that's because when gold was down $20 on Tuesday, they got destroyed. Gold stocks were down 4%. And I've been talking about that. They are scared. Anytime anything bad happens, a little bit of a decline, they run for the hills, which has characterized this bull market. It is climbing the mother of all walls of worry. That's why I said on a prior podcast that even though you're buying gold at record highs, you're a contrarian, because most people, even the longs, don't believe the market. And they've got one foot out the door the entire time looking for any signs of trouble. And that's exactly what happened on Friday. There was kind of like a 1-2 punch again that knocked gold down. I think it was down about $70. It was flirting with 2,400 on Thursday and closed below 2,300 on Friday. Silver got clobbered. It had gotten back up to 31.5 on Thursday. And then on Friday, it was down a couple of bucks. It closed close to $29, not below, but kind of near $29. So a big drop in gold and silver. This is before we got the non-farm payroll numbers, which I'm going to get into on this podcast in some depth. But before that was announced, the market was down. Gold was down about $40. And I woke up on Friday morning, and I saw gold down $40. I had no idea why it would be down, especially in front of a jobs report. Normally, you wouldn't see that because people would be worried. What if it was a weak number? Right? People would not want to sell gold in front of that number. Normally, if there's a $40 move in gold on a jobs day, it's in reaction to the number. Right? The numbers come out, and it's not what was expected, and so there's a bigger move in the markets as they kind of readjust to the new data. But gold was already down $40. And so I wanted to know why. So I go online, I do a little research, and I see the news out of China that China had announced that during the month of May, they didn't buy any gold. At least officially, they said they didn't buy any gold. They had bought gold for 18 months in a row, and in the month of May, they didn't buy any. And apparently, this is bad news. When the traders learned this, they immediately sold gold. Oh my God, China stopped buying. I mean, it's 1 month. So what? I mean, as far as I'm concerned, that's a bullish announcement, I think, because if gold made a record high without the Chinese buying anything, to me, that's pretty bullish. Because normally the Chinese have been buying, and even without the Chinese. Now, of course, when I say the Chinese, I mean the government. Obviously, Chinese people, the people themselves, didn't stop buying gold. I'm sure they bought plenty of gold. But the government didn't buy any gold for that month. But even without the government buying gold, gold made a new all-time record high without China helping. So to me, that's actually bullish, that gold didn't even need Chinese buying, and it still made. Why would they be done buying? They didn't buy gold for 18 months to stop now. This is just the beginning. They got a lot of gold to buy. Does it make sense that they backed off a little bit? Like all of a sudden, gold is breaking out to a new record high. Maybe the Chinese were like, okay, let's pause a bit. Maybe we'll get a little bit of a pullback. We bought for 18 months in a row, and now the market is kind of running away. Let's take a step back. Let's see what happens. Maybe we could get a little bit of a pullback, which ironically, they got based on announcing that they didn't buy. The markets have just given China a gift, not only because the market fell $40 on the news that China didn't buy any gold in May, but then we got the non-farm payroll numbers that came out later in the day that were stronger than expected, and that sent gold down another $30. So down $70 on the day. And so if the Chinese didn't think down $40 was a bargain, I'm sure they're buying tonight. I'm doing this podcast on Sunday night. I'm sure that the Chinese government is going to be backing up the truck and buying into this decline. They're probably laughing about how foolish Americans are, or Europeans. Little news announcement. They'll probably keep this up their sleeves for some future announcements when they want to buy more gold. They'll put out a news announcement like this so they can convince foolish Americans to sell them their gold at a lower price. And in fact, when they announced the fact that they didn't buy any gold, they were also announcing other economic data that evening. One of them, or one piece of data that came out, was their trade surplus, which swelled. The Chinese trade surplus is kind of the mirror image, and our trade deficit really shot up. I think I mentioned that on the last podcast. We had a big jump in our merchandise trade deficit, which is going to shave off a lot from our GDP. And in fact, when I recorded my last podcast, I mentioned the downward revisions to the GDP from the Atlanta Fed, and I said that I thought that that was just the beginning of a lot. And of course, the very next day on Monday, they slashed the estimate again for the estimate for Q2 GDP. But China announced that their May trade surplus swelled. That was a 7.6% increase, or as a result of a 7.6% increase in exports. And if you look just with the United States, their surplus with the U.S. alone in May ballooned by 13% to $30.8 billion. That is a strong economy. One way to know if an economy is strong or weak is look at how much they're producing. Strong economies produce surpluses. Weak economies produce deficits. So it's China's economy that's strong. They've got the surplus. And one of the things that they're going to be doing with their surplus is they're going to be buying gold. What else are they going to do with it? What is the Chinese government going to do with these enormous surpluses? Because assuming that Chinese exporters sell their dollars on the foreign exchange market for RMB, and the Chinese government, what are they going to do with the dollars they already have? What are they going to do with this massive stockpile of U.S. treasuries? Obviously, they're going to convert them into gold. It's ridiculous that U.S. traders would look at a single month where the Chinese backed off of their buying and just conclude that they're done, that this is it, China's out of the gold market, and this is horrible news. I thought it was bullish news that we made a new high without the Chinese. And I also think the markets got the jobs number wrong. Because once again, right, we got a non-farm payroll number that was greater than expected. And the markets immediately react. The bond market sells off. The US dollar rises and gold dumps, even though it's already down $40, right? It dumped again. The headlines are very misleading because all you have to do is look beneath the surface, and you don't have to look that deep. It's not like this is hard to figure this out. It should be obvious that these numbers mean nothing, that I don't care what the government tells us is happening with job creation. We have a weak labor market in the United States, and the non-farm payroll reports that came out on Friday confirm that we have a weak labor market, even though the government claims that 272,000 jobs were created in the month of May. Anyway, we're going to get into that report on the other side of this break, so stick around. So I want to get into the non-farm payroll number. So the consensus was for 182,000 jobs being created in May. So that's what everybody was looking for. And that would have been a slight improvement over the 175,000 jobs that were reported to be created in April. Well, first of all, the April number was revised down just a bit, 10,000 jobs lower, so 165,000. Oh, and by the way, before we got Friday from the government, we got the ADP number on Wednesday from the private sector. And that one came out below estimates. They were looking for 173,000, and we got 152,000. And the prior month was also revised down from 192,000 to 188,000. And so these are private payroll jobs. They don't even include the government numbers. But they're at 152. So that was a weak number. And so going into the official number, maybe there were some people that thought that this one would be weak as well. And I think that the ADP number is likely to be more accurate. The number came out at 272,000. That was well above even the highest estimate on the street, which was 225,000. The range was 150,000 to 225,000. So that headline number is what riled the markets. That's what caused the dollar to rally. That's what caused bonds to fall, yields to rise, and that's what caused gold and silver prices to decline. That and the average hourly earnings numbers, which were higher than expected. So inflationary, average hourly earnings were up 0.4 versus expectations of up 0.3 and double the up 0.2 from the prior month. And average hourly earnings year over year, which were supposed to be up 3.9, were up 4.1. And the prior month, the year over year number went from 3.9 to 4. So this is bad news, right? Because we're going further away from 2%. Instead of going down, we're going up. So we got stronger non-farm payroll number and hotter inflation numbers, right? So that's what was the market mover. Now, I agree that inflation is hotter than the markets. The inflation is not caused by rising hourly wages. It's the other way around. It's rising inflation that is causing average hourly earnings to go up, right? So you've got the cart before the horse. If you think that the rise in earnings is what's going to cause more inflation, it's the inflation that's causing the rise in earnings, and it's not a real increase. It's a nominal increase because prices are rising faster than wages. So workers are falling further behind as a result of this, this combination, right? Now, first of all, just looking at the rest of the official report, the unemployment rate went up to 4%, right? From 3.9 to 4. Nobody expected that. In fact, a lot of people thought the rate was going to drop to 3.8. So unemployment went up. That's a weak market. Private sector payrolls rose by 229,000, following a downwardly revised 158 for the prior month. That was well above estimates and well above the ADP estimate for private payrolls. Because remember, ADP estimated private payrolls. We also got the JOLTS report earlier in the week. That was weaker than expected, considerably. The JOLTS report is job openings. And in the prior month, there was originally reported 8.488 million jobs available. That was revised down to 8.355. The consensus for April was 8.4 million jobs. That was revised all the way. That came out at 8.059, way below the low end of estimates. This is one of the lowest numbers for available jobs that we've had in quite some time. That is evidence of a weak jobs market. Employers are not looking to hire as many people in April. Now, manufacturing, still a small number. We created 8,000 jobs, but the expectation was for 5,000, although we revised the prior month's 8,000 down to 6,000. So manufacturing only ended up with an extra 1,000 jobs versus what had been initially reported and what was expected. So really all the additional jobs were in the service sector, right? Not the goods producing sector. That's why these trade deficits that we have are going to get bigger. But look at the labor force participation rate.